Today we're going to be talking about pre-planning your trades for the open. Stay tuned, traders. We'll be right back. G'day traders, Stacey Burke from Stacey Burke Trading. A lot of great feedback yesterday, a ton of questions, a lot of stuff to cover, but today we're going to be focusing on how I approach the market each day, the pre-planning process that helps support your trade thesis, your narrative going into the session. We talked yesterday about how I've modified a couple of things in terms of around the opens, specifically around gold, and a lot of questions regarding some of the other pairs. We'll talk about that as well. But essentially, regardless of whatever instrument that you're trading, whatever market, whether that's equities, currencies, forex, futures, whatever, having a plan and a process each day is what supports you, gives you the confidence and the patience to sit back and have a thesis in terms of what you're looking for. And ideally, as I've talked about in gold, it moves every session. It may only be 25, it may be 50, it may be 75 or more. There could be a stop hunt trade, a squeeze, or it could be a stop hunt and then a trade. So there are some different scenarios. As I said, there are a lot of different variations. We're going to sort of walk through the basic process today. Before we do that, I just want to answer one question. One of the emails that I received was, why are you doing all this for free? You should be charging for this. Well, there is a charge. And before we get started, what I'd like you to do is
smash the like button for me. I would greatly appreciate it, and that will also help the YouTube algorithm get our videos out to more people and help them become better traders also.
And everything that we're walking through is exactly how it's going to happen in live time. My goal is to help other traders get better, and in the process keep improving myself. So thank you for doing that. So first and foremost, we talked about day 0, day 1, day 2, day 3. A lot of traders emailed me regarding those questions. Day 0 is the narrow range day. You can just call that an inside bar or a narrow range day. Essentially, the market trades in a tight range, but will often have a peak formation on the top and the bottom in a sideways range-bound market. For simplicity's sake, absolute simplicity's sake, I look at Monday as day 1. If it's a narrow range day or an inside bar, I'll look at that as a day 0 type scenario, and a day 0 type scenario can lead us into a potentially bigger day 1, day 2 move. So it may be a little bit of a day 1 move, but day 2 could be a big trend day, and that's when we can see some of these all-in days that just move and grind slowly all day long. They don't come back. Traders get caught counter trending them. I know I've been burned in the past, and I know that when you get the level 2 all-in day, you want to be trading with the trend. So as the week evolves, regardless again of whatever instrument you're trading, whether that's shares, futures, gold, people keep asking me, can you trade it on indexes? Can you trade it on shares? Regardless of whatever you're trading, study that instrument, understand its behavior. Every market will have individual large players that will tend to trade those instruments with certain reproducible behaviors. Now with gold, we see whether that's an electronic market maker, smart money, large pools, whatever that may be, but it is very, very specific to round numbers, timings, and very specific to the equity market timings as well. So when we're going through day 1, day 2, day 3, often Monday, Tuesday, Wednesday, I'll look for higher highs, higher or lower lows. If we're going down, we should be seeing lower lows, lower highs. If we're going up, we'll see higher highs and higher lows. We get to that day 3, level 3, Wednesday, Thursday, we might start to see two-sided trading, which is indicative of a potential level 3 area. Now level 3, we can see a continuation reset come out of that for a continuation trend trade, or we can see a reversal setting up for possibly a big move on a Thursday or a Friday back in the other direction. Now gold typically can give us big moves almost every single day. We'll see high to low range trades, we'll see moves in London, we'll see moves in Asia, but not always every single day in every single session. But each one of those sessions always has a move of 25 to 50 pips at least. So again, what day are we at? If it's a Monday and we're starting the week from fresh, again, I can use Friday's levels, Friday's high and low. Is my bias long or short? So again, I've talked about using the 50 and 200. The 50 basically, I know some traders use VWAP. Other traders don't use anything. It's entirely your preference. I like to see the visual assessment on the chart with the 50 there, especially if we've had a reversal or an inside bar. That can help me establish if we're now seeing a counterintuitive type of trade scenario setting up for that day. My major round numbers. Now this is probably the most important areas that I look at for each session. The timing window, which we're going to talk about in a second, but the major round numbers helps me establish before the market opens, just at the prior to that market opening, where is my 50 pip boundaries of major round numbers. We're going to walk through some examples, but what's important is that as the market is about to open, in Asia, typically that first hour can often be the opportunity to position in the market. Sometimes it will be the middle hour. Now with New York and London, typically when the London market opens in that middle hour and when New York opens specifically in the middle of that middle hour at 9:30 New York Eastern Standard Time, those timings are critical for those two markets. But the major round numbers are what I'm paying attention to. I want to know, does the market pierce through major round numbers? Is it piercing through and pulling back for reversal trades? Or are we breaking through and possibly layering on top and using those round numbers as support or resistance? Or is the market pinning into those levels because that's going to be the high or the low of that box? Now with gold we can see 100 pip moves, 0 to 0, 50 to 50, all those types of scenarios. So it's important that if we see the market, we have a high, we might have a low, the market goes into the open, the first thing I'm going to be looking for is previous highs and lows. So if we have consolidation, or we're coming into the new day if it's Asia, or if we're going into London from Asia, where are the highs and lows from that previous session? Because coming back to understanding a major premise about these markets, regardless of whatever it is that you're trading. Your objective is to make money. There's somebody on the other side who's after the same thing. They're after getting the money. So in a large majority of cases, once that previous session has printed, we now have volume contracted inside that are long and short, and the market is going to move to one side or the other in order to hit stops or to trap volume in a certain direction before they shift the market, because they want to stop out or hit stops, whether they take profit orders, breakout orders, pending orders, all of those types of scenarios, because that enables them to transfer money from losing traders' accounts into their accounts. Or if you're the winning trader, for you to get out of a winning trade, closing out that position to transfer the money into your account. So again, it's about the money, nothing else. It's about the money. So these round number boxes enable me to create a thesis heading into the session. If I'm biased that I'm looking at a long scenario, day 1, day 2, day 3, they could go up first and get the first mouse and then go down into round numbers, trapping traders or stopping traders out that get in early, triggering breakout orders. So we might trigger breakout orders for shorts, but meanwhile the market might be working its way back up now and not come back. It might go 50, 75 pips, whatever that may be. They've taken traders in early, they get them in early, they come back and they hit their stops. The first mouse gets stopped out, the second mouse gets the cheese. So sometimes we'll see the market pin into round numbers. Other times we might see the market work below the round numbers before finding support for the move in that middle hour for a continuation. So again, depending on if we're in a down market or if we're in an up market, that scenario will help me create my thesis for that setup. Now, coming back to what I talked about yesterday, what is my conviction on that trade? Is it a trend trade, a reversal trade, a range bound trade? Most of these are all going to be, for the most part, counterintuitive, which means that they're going to fly in the face of what seems rational to the average retail investor, which is why the numbers are so important, because the market, especially 50s and zeros, the market will trap volume often inside of these quarter levels and shift away. Traders are getting caught either in the middle at the median price, or they're getting caught in the middle around these quarter levels before the market shifts away. So understanding I'm willing to be patient, because the timing window, first hour, second hour, third hour, okay, 15-minute cycles, 15, 30, 45 double zeros, and again for the next hour, but I talk about using the 1-minute charts. I'm looking at the 1-minute charts at the extremes. I want to know, have they hit the stops? If they've hit the stops and we're at major round numbers, I'm looking for them to be locking that in with an engulfment or a 3-bar reversal, and I'm paying attention to that 15-minute cycle, because typically we could be 15, 30 minutes into that hour where the market is working that third 15-minute rotation, which when you look at your 15-minute chart may end up as a pin bar because they've pinned through a level or they've engulfed a level up top and they're coming back down to get the traders who are in the other direction from an earlier session or from earlier in that day. So again, the process, we're looking at major round numbers, the timing window, we're looking for the types of trade setups that are going to present. So again, my thesis, is this a trend trade? Am I looking at a reversal trade? So we could be going long, but the market's going down. The market's going down, I'm looking for a reversal. What does a reversal trade look like? We're going to look at a couple setups of those from yesterday. I talked about the simple squeeze setup. We're going to look at an example of that from the New York session. And we'll also look at the reversal trade that came out of that after the stop hunt at the open of the New York equities market. So again, the pre-market, I don't want to go into too much about that just yet, but the pre-market, how did it set up? Did they go above zeros or below zeros and then pull the market back? Whenever they break through a double zero level in the pre-market, that means there's going to be pending stop orders above or below those levels, which can often give us an indication that the market is probably going to be returning to that area later in that session. So again, understanding that we're looking to see, does it accept or reject those round numbers? Is it piercing through levels, trapping volume, hitting stops? What levels are significant for me to be looking to position myself in the market at that very specific time when the equity market's open? Or is it a first hour opportunity for a reversal or a trend trade in a possible blow off or a beginning of a strong move? Day 1, day 2, day 3, again, I keep it so simple: Monday, Tuesday, Wednesday. And if you're not sure, observe, just watch and learn. Again, as I said yesterday, don't be in a hurry to try and trade the 1-minute chart. I only look at the 1-minute chart at very specific times at the highs and lows, and it's very specific. So if you're trading in these other gap times outside of the 12 candle window, I would caution you, unless you're at the very high or low, to be careful about getting caught into some trades that potentially may not go anywhere until the next session starts. And now you may be caught in the middle waiting. The whole reason I like to trade the open is because, as you've probably observed from yesterday as well, when these markets open, they move very fast and quickly to hit stops, and often will reverse it just as quick and start grinding their way back in the other direction for the trend trade of the same distance or even more. But some of these trades can be over in less than that one 15-minute cycle, so that 15-minute bar may be the stop hunt for 50 pips, as we saw in the New York Open. They get a 3-bar reversal, they pinned down through the quarter level, came off of 50, and worked their way back up for 75 pip move back in the other direction, which was about 30 to 45 minutes. So we'll look at the examples from yesterday. Again, preparation is the key. Having your process down, and each session duplicating that. My major round numbers. What is my bias? Are we day 1, day 2, day 3? Is it a high probability opportunity? How much conviction do I have behind this move? Is it a level 3 where we're possibly at the end of the move, or are we now possibly at the beginning of a major leg for the week, and I can look at possibly going in with more size or more risk on this trade? And if I'm wrong, where's my absolute hard stop on this trade? The one important thing somebody asked me yesterday, they said that their stops are too big on gold. Now, depending on who your broker is and what your spreads are like, that 2 decimal point on the end may confuse a lot of traders. Typically, the spreads are going to be anywhere, my spreads are around 2 pips on gold. Now, some traders may read that as 20 pips because of the extra decimal point. It's 2 pip spread. If you think your spread is 50 pips, then you're probably misreading the decimal point, and you can probably check that on your platform, on your demo account, by putting a micro lot in or something to see what that cost is per contract with the spread. So not everybody's spreads are going to be the same, but generally speaking, if your spreads are a bit bigger, I would just scale your size down. And as I mentioned yesterday, just trade on demo. It's more about the process. It doesn't matter which pair you're trading. It could be the British pound. If you're at major round numbers, there possibly will be a high or low opportunity. The pound loves double zeros. Now again, as I mentioned yesterday, some of the other pound cross pairs had larger spreads. They didn't move as much, and what attracted me to gold and allowed me to keep refining this with some help from some other traders was understanding how much movement was occurring and using that smaller time frame at the very specific times because of the reproducible nature of this instrument. So again, yesterday had some huge trades. Wasn't an absolutely massive trading range for the day, but there was a ton of opportunities in Asia, London, and New York for 50 pips, pretty much in each one of those 3 sessions. And they were over reasonably quickly. So again, some of those trades are going to be counterintuitive. We're going to talk about the London trade yesterday and understanding the importance of the major round numbers for acceptance or rejection of double zeros and 50s. Very important. So let's take a look at the charts from yesterday. Thank you again for all the questions and feedback. I will try to make sure I get through all of that information. But again, the same stuff is going to happen every single day. Some of it's going to make sense. Some of it's going to fly in the face of what seems rational. But simplicity, step back, and I start to identify some of the simpler trades that you see. You're going to see trades in London that go up in the pre-market and then they come down into the London Open and give a W and scream away. You're going to see W's, you're going to see M's. You're going to see them on the 1-minute charts all the time in that Europe-London session. You're going to see them in New York. There was one in London yesterday, one in New York. Last week we saw W's as the market was coming. It was a down week and we saw the market working back up in the London session. When the market's going to go up, you're going to get a W in London. When it's going to go down, you're going to get an M. Same thing in New York. So really some simple stuff, but at the same time, as we talked about, it's a skill set that requires you to be developing that in live time, and that's where some of the counterintuitive stuff flies in the face of what seems rational to what you learned in technical analysis. So the number one reason that I love trading the opens is that I don't want to be in the market. I want these trades to be over quick. I talked about the squeeze setup. We'll look at the one in New York Open last night. Beautiful trade setup, and it was over quick, and then there was a reversal opportunity coming back the other way from 50 back in the other direction. So positioning yourself in the market with a 1-bar stop. So coming back to traders mentioned to me that some of the stops were 40 and 50 pips. On the 1-minute chart, your stops will probably only ever be 15 pips max. So if you're looking at a 15-minute chart, you might have a larger bar there. And as I mentioned before, even though the bar is large, when it's the right bar, very rarely will you ever see that market come back into that candle by more than 10 or 12 pips. So let's look at yesterday's charts. Have a great trading session. Stay focused. Plan every single session. Look for 1 or 2 really good trade setups. Keep your risk controlled. Pre-program your targets in the beginning. Start taking pips off the table because they will move super fast. And sometimes if you don't have it programmed in, it hits the target, you don't have it programmed in, and it comes right back a minute later or 2 minutes later, and you would have already been out with 25 pips. That seems really fast, but at the same time, once you start watching these charts and you understand the rotation of the 15-minute cycles and the hour, and you're looking for that 1 or 2 really good trades that are over in less than 15 minutes sometimes, that 1 minute you can start to really get patient because you're starting to see the behavior around the numbers, around the high and the low. It starts to come together, and when you watch for that 15-minute rotation to complete, or getting close to complete if it's into 45 minutes into the hour, that sort of scenario, now the trade makes sense. Stay disciplined, traders. Stay focused. Keep it simple. Keep getting better. And may the markets go with you.
Okay, so we're talking about process and pre-planning each trade for each session. Now, being in Perth, I have the opportunity to be participating in all 3 sessions. Now, for some of you in other areas, whether you're in the US, the UK, Asia, wherever that may be, in Europe, some traders may only have the opportunity to be trading certain session times. And again, the process for me is the same. Every time we head into the next 12 candle window, I'm looking at my major round number boxes in terms of 50s and double zeros. So every session, I'm looking at where are my round numbers. We head into Monday morning, the market opens up, which typically is when we will see the market gap in gold. Often we may not see a lot of gaps between Monday and Friday on the rollover, but definitely Sunday to Monday we can see the market gap. This market has gapped up, but in reality, this is just a continuation of the long trade. So again, coming back to where are the highs and lows, where are the stops? The market breaks through the previous day's high, but pulls back just prior to the market opening. And again, this is where we look at our major round numbers. So we see an engulfment prior to the market open at the high, 25 pips above. So we see a push up, a pullback, and a second push before the engulfment occurs off of the 75 level. So heading into the session, because the market is already in transit coming down through 50, the next place I'm going to be looking is on my 1 minute chart to see where we're at when the market trades in that first hour. So again, I'm looking for trades that are going to come off of 50s or zeros. Now, when that's the case, again, what is my thesis? Well, the market's already down inside of 50, median price is 25, and I'm not looking to trade this instant first break of the first bar. What I'm looking for is how does price behave in the open. Now, some traders may be wanting to short this at 50 as soon as it comes up. Now, there's a, for traders to trade that right off the bat is entirely their choice. Now, this is a stop hunt into the existing short trade that's come off of 25. Now, if we come back and look, you'll also notice that this trade starts at the beginning of the second hour. So the market has gone up and done 3 pushes in the first hour, pulled back, and then at the end of the first hour goes up 1, 2, and pulls back and squeezes inside of the EMAs at 25. So again, understanding the timing window, the second hour has gone up now and closed and engulfed at 25, but also now we have a rectangle for structure up top. So coming down into the open, my bias is already that we're in an existing short trade. Now, when we look back at our 15-minute chart, our bias is that we're long. We came out of a reversal day on Friday. We came above the 50, which again, I mentioned to traders. I use 50 as a visual support. Some traders use VWAP. I don't like the VWAP for currency. But again, knowing that I'm on top of the 50, my bias is still in the long direction. We had a reversal day on Friday, a level 1 day, possibly a day 1 scenario. So possibly a day 2 trend day on Monday. So we've come down below 50, but again, my existing trade in the pre-market is down. So I'm looking to be trading either long off of double zeros or short off of 50, but I need to see how price behaves first. In the first 15 minutes, we see the market go up right away, 1, 2, 3, hitting stops, and then pulls back inside. Now, again, understanding the 15-minute rotations is that we're looking for the market to put a high in place, put a low in place, and then work into one side to give us the trade because we're in an existing move. So now I need to watch how price behaves. We're not in a blow-off. If this was a blow-off, it would have blew down through zeros and then given us something possibly down low. This market is moving down, and the stop hunt is back up into the existing short trade. They move it back into 50. They come back a second time and then a third time, and they roll over, giving us the squeeze. And this is again at the beginning of the second hour, the middle hour. But you'll also notice that we have our M structure here at the end of the first hour. The market's come down and worked up into 50, giving us a peak formation high, comes down, gives us a peak formation low, works back up into the high, works back up into the high, drops down and goes sideways. This consolidation underneath the peak formation at the beginning of the second hour is our opportunity to enter this market for the move back down into the low. So again, now we're down at double zeros. We see one push, we see two pushes, and we see three pushes. Now again, somebody asked me at what point would you come back for later? If I'm in this trade, which I was, and I'm out of the market, once I'm done, I'm done. I don't really care what happens after this. The market could roll over again and keep going. Typically, once I've taken my trade, especially if it's 50 pips, I'm quite happy usually to walk away. But my primary premise right now is heading into the session, where are my round numbers? What is my bias? If I'm counter trending into my bias, so if I believe the market is going up and the market gives me an ideal short trade entry, I am aware that this market could fail at some point around the double zeros, coming down into that 50 area. You'll notice we're also where stops were from the previous swing lows. We're at double zeros, but also I may not trade that with as much size, knowing that I'm counter trending the original underlying bias that I have for this market for that session. Now again, the market goes into consolidation and moves sideways. Okay, again, another telltale important. We'll talk more about pre-market trades later. Pre-market will usually revisit one of the extremes or in the gap times, but this sideways horizontal consolidation after a peak formation is in place, we do not want to counter trend the peak formation. We get the consolidation for the fast move in the other direction back towards the high of the session from Asia. So again, we head into our next 12 candle window. Again, our bias is still in that long direction. We have our high of the day. So again, just not looking in hindsight, we're talking about what's our prep before the session. Where's the high and the low? What is my underlying bias? So if my underlying bias is long and I get a short trade, I understand that that short trade may be the stop hunt, and I still may have an existing trend trade that can present if I want to participate in that move. So the market, again, heading into that session, our major round numbers now are 50, but we're in between the quarters. So again, our 50 pip box is 75 and 25, except that our high of the day is above 75. So now we're aware that the market has stops. We'll just highlight this area. The market has stops just underneath double zeros. Well, chances are it's going to be going to double zeros. That's important to understand. If you have highs and lows that are up near the extremes or above 50 or below zeros, or above zeros, below zeros, above 50, below 50, chances are, and it's pre-market, the market is going to be revisiting those later in the session. We head into our session, and again, I talked about how indicators can get traders caught into following the moves, the first mouse. Now, again, you'll notice that the best trades come out of consolidations. Now, again, we're not talking about three push patterns or stop hunts. Once the stops have been hit and the market goes into those levels, those are opportunities to position yourself at the numbers at the very specific times. But the key important concept to understand is that these moves, if they're trend trades, once the stops are hit, so if we go back, we put in some high of the day, low of the day lines, we can see that the market heading into the gap time has hit the stops of the Asian session highs, but then it breaks through in the beginning of the Europe 12 candle window. So we also know that there's stops below our last peak formation on the way up into that move. So again, we're now getting up higher. These indicators are taking us up higher, but this is the first hour. London has not opened yet. London opens in that middle hour, and I'm going to tell you 99.9% of the time, London is where you're going to see the move. So if the market pulls back and gives us a high of the session scenario up top, as we head back down, so we're into the 45 minutes into the session, this trader has gotten into the market, they're filled at 60. 45 minutes into the session, they're still only up 15 pips. Chances are now that this rectangle up top, the last low before the high, is going to be where we see our measured range come back to stop hunt traders who are in the money. Whenever you see higher lows heading into a session and then the market fails to continue through a level, London opens, we talked about this, London opens down underneath and goes sideways. The sideways consolidation is where we can see the explosive moves. Think of this like a slingshot. The market coils and then moves very fast and quickly to clear the stops of these higher lows and of traders who are long off that consolidation. So wherever the profitable trades are, you can pretty much assure that those trades are where that bullet-like explosive stop hunt will come back to. So again, we see one push, two push, three pushes down, but again, timing-wise. So if there's an hour up and then London is an hour down, we're going to be thinking end of the hour or beginning of the next hour. This little bullpen engulfment reversal, 25 pips below the double zero. So let's go back again, talking about our 50 pip box. London opens up at 50, goes down through zeros, one push, two push, three pushes down, an engulfment 25 pips below the double zero. So again, understanding 25 pips above 50 and a reversal for an explosive move back down through the 50 and double zero box. Then one more push through 25 pips below the box, hitting stops at the low of the Asian session, pulling back inside, and then heading back in the long direction. So 50 pip box, a 25 pip stop hunt above, the coil inside at the open of the equities hour for the fast aggressive stop hunt down. So where are my round numbers? What type of trade situation am I looking at? Is it a trend trade? Is it a reversal trade? Or is it a range bound market? Now clearly in this particular case, the opportunity in London was a reversal trade setup, and we had 50s and double zeros. The market then at the end of the hour, so 60 minutes down, the next hour is 1 minute away. 10:55 we get our bullpen engulfment. It pulls back inside, goes sideways, and then continues the move back up in the long direction. So again, paying attention to 50 and 0. The market pulls back from 50 in the gap time, but then breaks through above 50. Above 50, clearing out all the stops from the previous highs and lows that haven't already been hit. And then prior to heading into the U.S. session, again, you see we clear the double zeros up to 25. They pull it back. And then in that last 30 minutes prior to the U.S. session 12 candle window, we get three little pushes above 50 before they engulf it, and then a 25 pip stop hunt back into the long trade. So a 25 pip move down. We're already above zero. They've locked in 50. Again, our premise, where are our round numbers? But we're in a strongly up market. Our bias is long. We're looking for a stop hunt against the trend to position ourselves in line with the trend. So we have stops that are above 50. So clearly now, if this market is still going to continue to trend, we know this market is going to be doing a minimum of 25 pips beyond the highs, which again, it coiled underneath. Whenever you get a coil underneath of a high or beneath on top of a low without taking out the highs, this market is building up energy. 45 minutes, 30 to 45 minutes, coiling before exploding through and continuing that move. So again, what's my bias? What's the setup? Is it a trend trade, reversal trade, trading range? Where are my major round numbers? What is my thesis? Where am I looking to position myself? How am I going to control my risk? Is this a 2-to-1, a 5-to-1, a 10-to-1? All those scenarios, and then going in there and understanding what you're looking for and watching the clock, understanding the 15-minute rotations, the 30-minute, 45 minutes as you're getting into the next hour. Where's the equity markets now? Are they opening up high? Is the equity markets taking traders further into the extreme? Or does it stop hunt back down and after 30 minutes hasn't even gone anywhere, only 25 pips for a continuation back in the long direction. So again, an example of a trend trade in the open of the U.S. session. So we head into the new day. Again, I talked about looking at major round numbers, and just as the day preps, I'm not talking about trading this, I'm talking about understanding what's already happened. So we see the market in that first 90 minutes lock in the double zeros with our W formation. We have our smaller geometry. We have existing stops above swing highs from the U.S. session. The market breaks through the geometry. Again, traders, I talked about using the EMAs for squeeze recognition of squeezes when we're heading into the session, but also knowing when we are in a trading range. So we're not looking at those, we're looking at the highs and lows and the major round numbers. But if we're in a trend trade scenario, I want to be moving with the strength of that underlying direction. And again, just paying attention every time it gets to major round numbers, how does it behave? So we see the market clearing through 50. It gets to 75 and goes sideways. The second hour gives us our continuation trade with our W formation and our engulfment. Now I want to just have a very specific look at this 3-bar pattern. I'll just zoom in on this. This 3-bar pattern, you're going to see this all over the place. We'll zoom in. 3-bar pattern. We see a 1, 2, 3 down, a doji sideways, and an engulfment on top of the 50, but also at the low of the hour. So the hour began with this large bull candle. So the low of our hour is right there. It comes down to the low of the hour in the middle hour of the 12 candle window and gives us our 3-bar reversal pattern. Now we're going to look at 2 examples from yesterday. Same scenario, different variation, but the same pattern. So we head into the London session yesterday, and again we see the market consolidate sideways at just below double zeros in the gap time. And then at the beginning of the 12 candle window at the Europe Open, the market breaks out before coming back and hitting stops, and then engulfing on a little 3-bar reversal again, a variation of that at double zeros, and starts to grind its way up 25 pips. Now, again, understanding the market opens up, it makes a high, it makes a low, and then it starts to work one side. Now, again, London and New York, specifically that middle hour, the equity markets haven't opened yet. So I'm prepared to let this trade because I know when London opens, it is still going to move. This is not the move I'm looking for. The market makes a new high. That tells me they're working the high. They're 25 pips above the double zeros. We're above double zeros. So chances are we could be moving further in line with our underlying direction where our bias has been for the long trade. The market then, for the next 45 minutes, proceeds to work into the high before going 1, 2, 3 to the high towards the end of that first hour, pushing again, and then coming down and engulfing the middle structure. So there's our M formation pattern right on the first bar of the London Open. So we've got our M structure. The market then drops down and goes into consolidation. This was a trade at 25 for the reversal trade, back into traders who were long at the beginning of the session. So this is, again, an example of a trade scenario where I'm counter-trending the underlying bias. So that's a trade that I will take with, tight risk, probably a third of size, because, again, I'm counter-trending. So I'm looking for 25 pips before this could fail. It could continue, but most likely in a counter-trend scenario, you get 25, a sideways move, and if it's going to continue, you'll be able to position yourself usually 30 minutes into that consolidation roughly for a continuation move. Now this market gives the 25 pips, goes into consolidation. The market then blows off through the double zeros down to the previous day's low. And what do we see? At the end of our London hour, 45 minutes, 38 minutes into that hour, we see the move and we see our 3-bar reversal engulfment. So again, the same pattern we just talked about a 1, 2, 3, a doji, and the engulfment at the previous day's high. So when we look at our 15-minute chart, we can see that the market has come down. We'll just move ahead. Sorry, we're in the wrong day. The market has come down and pushed into the high 3 times. 1 push, 2 push, 3 pushes. So we also see 3 pushes up, but we see a breakout pullback and 3 pushes into the previous day's high. On our 15-minute chart, as this reversal is printing, we're coming back up. We go sideways and continue. This is an opportunity. There's 2 opportunities. Some traders, again, this is counterintuitive, but we're at the 3rd 15-minute rotation. We've already put a peak formation low in. The market has hit the stops, but we've got our 3-bar reversal pattern. The market moves up, hits stops. This is another opportunity to re-enter the market. So you could have a trade down low if you're waiting. So again, recognizing this is a peak formation reversal as well. Another opportunity to move your initial trade to break even and re-enter this trade, knowing that your new target now is going to be the high of the Europe Open. Major round numbers. The market pushed up 25 pips and then worked its way back down into zeros, hitting the stops, engulfing, and reversing. So acceptance and rejection of price. The market is working into double zeros. It breaks out and rejects being below double zeros and pulls right back. Acceptance of the double zero area for the continuation. 50s and zeros. The market moves right up to 50 and rejects. Pushes down 1 push, 2 push, 3 pushes into our trend. We get the 3-bar engulfment again. So another example of a strong trend trade in engulfment. So for traders who are saying, oh, it's all fine, it's hindsight, here's what I want you to pay attention to. The clock, the timing, and the highs and lows, because you're going to see the same thing over and over again. It's about the timing window, and it's about the levels in terms of the highs and lows and the stops. The market goes up, it hits the stops, 25 pips above double zeros. Equity market opens, it comes back and hits the stops on traders that are long, works into the zeros, hits the stops, engulfs, and comes back in the other direction. There is no rocket science here, but again, it's counterintuitive, and it's understanding that as we get to the end of each hour, now we could be seeing and be looking for these reversals. If you're in this trade short, you're covering this trade. Would you go long? Maybe put a teaser in here, a position, you've got a 1-bar stop. It starts to confirm. Go to break even. Add a second position in if you were trading this. Or if you understand what you're looking for, you're out of the initial short trade, you're long off the bottom. We head into the U.S. session, and again, we see the similar consolidation, the sideways movement between 50 and 0. You'll notice median price is 25. They capture all the volume. Lower highs, lower lows are all inside. So again, ideal trade scenario for a blow-off stop hunt. And we see the market into the open do exactly that. Market consolidates, whips back and forth, breaks out, hits stops, pulls back, hits stops, comes back down, pins through the lows. And again, remember, this is the first hour. The equity market, the middle hour has not traded yet. But then we see the market give our little 4-bar reversal pattern, catching traders shorting this. So 1 push, 2 push, 3 pushes, a 1, 2, 3. It reverses and then comes back up. So again, coming back up towards the end of the first hour, similar to what we just saw in London. The market breaks above 50. So an example now where we've broken above round numbers and it pulls back. We're heading into the middle hour. We get to the high and the market rejects, reverses, and then breaks back down through 50. We have our M structure. The equity markets have not opened yet, but we have our M formation. We have stop hunt above 50, which again, if we zoom back and look, we can see this is the trade, the stop hunt into traders who were short after the peak formation formed at the high of the day in London. So again, timing-wise, just being patient and waiting and letting, especially New York and London, letting that first hour show its hand. Stop hunt high, I'm looking for a short trade. Market, if you're short up top at 50, you're in this market heading into the open of the equities market. Consolidation, now our squeeze trade. We have our squeeze trade. The squeeze is the consolidation and the sideways price action coiling inside of these moving averages. That's where I'm looking for an explosive fast move. You're at break even on the original position. The second move should be fast and aggressive. And again, knowing that they're going to hit stops from the previous sessions. Asia, London, maybe other times. So again, we talk about 25 and 50 pips. Our bias was long. We're day one, day two. It's Tuesday. We're in an up scenario above 50. We get our 3-bar reversal, and then almost the very last candle of our third 15-minute bar rotation, 15 minutes after the equity market has opened, we get an engulfment of that 3-bar reversal structure at 50, 50s and zeros. Okay, so this is an example of a 25 pip extended stop hunt into the quarter below, the 3 pins, and then the little engulfment bar confirming all of that. If you're not already positioned in, there are traders who are going to be buying the third tap down to the low. So we've got 2 pins down low. We've got an extended 50 pip stop hunt down, positioning themselves. This is the blow off move at the open of the equities market. Our bias is long. Traders are positioning themselves at 50 with a 1-bar stop. And of course, when you're in the middle of a range, this is the first level that reversal trade will target. Stops in that middle of the range. So heading into Asia, again, we'll just zoom out. We're going to look at the 15-minute chart. So preparation. So coming into the session, we see our bias is long, but we've crossed now below our 50. We possibly have a level 3 scenario in place because we've got a peak formation high in London and New York, but they also put a peak formation low in and then a lower high. So we've got that sideways price action at the high of the week after Tuesday. But then the market comes down, works down into the peak formation low, works down into 50, pulls back, works down into 50 again. So in this situation, the first thing I look for is the level that gives me my low of the day. I draw down to the level that takes out the stops. There's my box. My box is at 50. They pinned into it prior to the close and went higher. So I'm looking for a possible area around 50 that could give us an opportunity. So we have 50 and 0. Now this market could blow through. So again, we watch how price behaves. We see in the beginning, in the pre-market, 1 push, 2 push. And then at the beginning of our Asian session, we'll zoom out. We see the market pull back into 75. Again, an example of where our EMAs have us trading down, but we know that 50, our major round numbers are 50s and zeros. We're either going to see this market blow through 50 and pull back, or work into 50 and give us an opportunity for some sort of peak formation reversal trade. Now, this trade may not be for everybody because, again, it's counterintuitive, but the more you see these opportunities present, they've hit the stops, they've hit all the stops, they've traded into 50, they've hit the stops from the day itself, but they've also got our reversal pattern. This extra little a bear candle that's dragging traders further away is the second grab at the cash. They reverse that, but this sideways consolidation, now, as I mentioned, the sideways consolidation, 1 push, 2 pushes, 3 pushes, is our little W underneath of the high. This is a big coil. This little area in here, as we head 40 minutes into the first hour, okay, we're 40 minutes in now. We've put a peak formation low in. They've barely touched the stops. We've got stops above, peak formation stops. This is a coil. This trade is going to explode through and continue to move. We get 25 and then 50 pips away, and again, the market breaks above double zeros. Breaks above double zeros, works its way back down before engulfing above double zeros and then coming down again in 3 pushes. So again, just timing wise, understanding we're at the beginning. So this larger bull candle is the beginning of the second hour. So we watch how price behaves. Our underlying bias is long. We're already in an existing long trade. If you're in this trade or you're continuing to trade this, the market puts a peak formation low in through the 50 before pulling back. And again, we've already broken the double zeros and worked its way back up higher, continuing to move through and eventually pushing up towards 50s and zeros. So again, coming back to process, each session going into the market, understanding that the trades may be counterintuitive, but to have your underlying bias there, and then allowing the market to trade and set up. So you miss the initial move, the peak formation. The market, if this market's going to trend, so you see the market come off of 50, you're thinking, oh, I missed the move, but this sideways consolidation is the opportunity to enter the trade. There's still a 50 pip move in this opportunity. So again, an example of structure. We can take the high and low of this structure at the open of the session. So we're 50s and double zeros, and just projecting that forward, knowing that this may be a full 2 expansions of that range. We're on the 1 minute chart, and again, 15 minute will give us our bias and our levels. And again, as we head into the gap time now, we're still looking at our bias being long. We could see a blow off. This market could take us even further away at the open of London and fade back and drop back down, or we could see a stop hunt back down into traders that are long with these higher lows getting stopped out before continuing the move. But we have our underlying scenario of the market. Again, you'll notice this lower rectangular structure working into 50, working into 50. They've broken above 50 yesterday, so we know we have stops that potentially can take us up to the double zeros and maybe even into the next 50 pip box. So hopefully you got value from today's video, traders. Planning and preparing, just stepping back. We're looking for 1 or 2 good trades and paying attention to the timing rotation. That's critical, and the behavior in that equity market opening time. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.